Okay, hello everybody. Welcome to this next session of the conference. This is paper session 2A, which is on ESG performance and financial performance. I'm Rodri Priest, I'm the Senior Head of Industry Research at CFA Institute, and I will be moderating this next session. We have 4 papers to get through in this session. Each paper will be presented for approximately 10 minutes, and at the end of all of the presentations, we will have time for Q&A. To that end, please can I encourage you to submit your questions via the Q&A function on the Remo platform. I'll be monitoring the questions as they come in, and we'll have the opportunity to put those questions to the presenters at the end of the session. The topic for the session on ESG performance and financial performance is obviously critically important. Achieving superior risk-adjusted returns is typically a primary motivation for ESG investing among institutional investors. And so the evidence on its link with financial performance is clearly important if ESG investing is going to continue to attract capital flows and move into the mainstream of finance. So without further ado, we're going to move on to the first paper in this session, which is on Do Low Carbon Investments in Emerging Economies Pay Off? Evidence from the Brazilian Stock Market. And the presenters for this session are Felipe Cunha and Eric de Oliveira. Felipe and Eric are research fellows at the Pontifical Catholic University of Rio de Janeiro. They are also permanent employees at FINEP, a federal state-owned company whose mission is to promote sustainable development in Brazil through the public fostering of science, technology, and innovation. Their research on sustainable finance and investment has especially focused on financial performance of sustainable portfolios worldwide, and their research has been published in a variety of academic journals. So with that, I would like to turn over to Felipe and Eric. The virtual floor is yours. Thank you very much.
Okay. Thank you, Rod, for the presentation. And good morning, everybody. My name is Felipe. I'm here with Eric to present our paper, which we submitted in February, but in the last months we made some improvements in this paper, and we are going to present the updated version of our study here. And in this study, we basically assess the financial performance of low carbon investments in the Brazilian stock market. Are you going to share? Yes, Eric will share here the presentation. Let's go. Can go. The second slide, please, Eric. Thank you. So climate change is a very relevant sustainability issue. There is a specific sustainable development goal to address mitigation and adaptation. Climate change also has created many opportunities and risks to financial markets and investments, as we observed in the last paper session here. And for investors more specifically, they are trying to understand all the financial impacts of climate change, especially on their portfolio performance. And sustainable finance and investment literature has contributed to this effort and assessing the financial performance of sustainable investments worldwide, but generally these studies has considered broad sustainability or ESG aspects. So we consider that climate change is a very important issue that should be more specifically addressed. So due to this relevance of climate change, a new area of knowledge has emerged, climate finance, and there is a stream of this literature which has assessed the financial performance of the so-called low carbon investments, or those investments compromised with the reduction of carbon emissions. And these studies have focused on carbon efficient companies, or those funds and portfolios screened based on mitigation criteria. And the overall results of these studies suggest that these low carbon investments enhance corporate financial performance and portfolio performance as well. However, we could not observe in this literature any study that considered those stock indices that represent a portfolio of shares screened based on carbon efficiency. So in this paper here, we try to address this issue, basically analyzing the financial performance of low carbon investments in Brazilian stock markets using the ICO2, the Brazilian Carbon Efficient Index, which is listed in the Brazilian Stock Exchange, the B3. Please. Yes. We chose Brazil because it's one of the most important developing countries in this climate change context. It's the 11th largest carbon emitter in the world. And in 2004, the country reduced dramatically its carbon emissions, basically through some command and control policies to reduce deforestation in the Amazon region. But especially from 2012 on, these disincentive instruments reached an efficiency barrier, and the carbon emissions in the country stabilized in a very high level yet. So we can also observe in the last years, more specifically, a recent reversion of the environmental policies and governance in the country. And this situation imposes a larger importance of the private sector and the investors to support the Brazilian efforts for climate change mitigation. So Eric will continue with the methodology that we developed.
Okay, so thank you. I could hear my voice here. It's kind of strange, but that's fine. Okay, so the idea here is to compare the ICO2, which is the benchmark that we are using for low carbon investments in Brazil, and compare it with other indices listed on B3, which, as Felipe mentioned, is the Brazilian Stock Exchange. So we compare ICO2 with the Corporate Governance Index, which is another sustainability index, and with the Broad Sustainability Index, the ISE. We also consider three different sectoral indices: the Electrical Energy Index, the Industrial Index, and the Financial Index. And we use the market benchmark, the Bovespa Index, and the CDI, which is the Interbank Deposit Rate, as the risk-free rate of return in our experiments. So to assess our results, we use several portfolio metrics, which encompass both well-known measures and also more sophisticated approaches in the literature. We start, for instance, with the Janssens Alpha, which provides us a view of an excess return of a particular index with the return of those indicated by the CAPM model, which the risk-adjusted model would be, like in brief terms. Sharpe ratio, modified Sharpe, Traynor, and Sortino ratios, they also represent a differential return in relation to the risk-free rate of return, divided by a specific measure of risk. Sharpe ratio considers the standard deviation. Modified Sharpe ratio considers the value at risk. Traynor uses the systematic risk, which is the beta. And Sortino ratio uses the measure of downside risk. Finally, there is also the omega ratio, which represents the probability of an index incurring in a higher value of a minimal expected return, divided by the probability of the same index incurring in a lower value than a minimal expected return. So, just to have a brief overview of the results, first we present here the compound rates of the returns and the standard deviations. And as we can see, ICO2 offers somehow an intermediate performance. It's not the best, but it's not the worst in terms of return. And the same could be said in terms of standard deviation and in terms of systematic risk, which shows an exposure to the market overall. When finally we turn to the results in terms of portfolio metrics, the same applies. We see that ICO2 offers a balanced performance. It's, once again, it outperforms the Broad Sustainability Index, it outperforms the market benchmark, and also the Industrial Sector Index. But at the same time, the Electrical Energy Index, the Corporate Governance Index, and the Financial Index, they all outperforms ICO2. In terms of metrics, here we could say for ICO2, a good performance in terms of Janssens Alpha, which signals an importance of this index in providing excess return to that expected from a specific model, the CAPM. But if we turn, for instance, to the omega ratio, we see that the results were less promising when compared to other indices, particularly when we consider risk-neutral investors, those whose the minimum expected return is zero. So, as we could note, the ICO2, as I mentioned, offers a good balance between risk and return. Sometimes it outperforms benchmarks. These results were also endorsed by robustness tests conducted under different periods. Still, we can observe a high performance in terms of financial performance of the financial index and on good corporate governance practice. On the other hand, we see that the trends show that investors are looking for favor towards companies that make efforts to contribute to a low carbon economy. So this could be a potential indication for a turnaround in the ICO2 or even an increase in its performance in the long run. So to conclude this work, in this work we assess the performance of ICO2. We use this ICO2 as a reference for low carbon investments in Brazil. We consider different classic and modern portfolio metrics. And overall, we could say that investing in carbon efficient companies in Brazil has so far positively contributed to portfolio performance, while at the same time reducing climate risk exposure for investors, such as carbon pricing, adverse shocks to industrial productivities, among others. So as direction for future research, we could suggest to investigate sustainable investments aimed at climate change adaptation as well. We focus here on mitigation. Investigate the causal relationships among climate investments and their outputs in key emerging countries, and also explore the distinct features of the ICO2 and other indices in Brazil, such as their ability to hedge against strong market volatility, or providing excess returns during periods of intense political turmoil or other critical periods. So that's basically it. Thank you all for the opportunity. Feel free to contact us and be happy to take questions right now.
Okay, thank you, Eric, and thank you, Philippe, for that presentation. And we will return at the end for any questions related to your paper today. So with that, can I ask our next speaker to step up to the virtual platform here? And our next speaker is Olivier David. He will be presenting a paper entitled A Sustainable Capital Asset Pricing Model, Evidence from Green Investing and Sin Stock Exclusion. Olivier David is a final year PhD candidate at finance at Tilburg University and ISFA. In his research, he studies asset pricing and impact investing when investors have pro-environmental preferences. And in his paper today, he will provide a theoretical and an empirical analysis of the impact of ESG integration and exclusionary screening on asset returns. So with that, I pass over to you, Olivier David. Thank you.
Thank you very much, Rodri. Today, I'd like to tell you about sustainable asset pricing. As you might know, the two most widely used approaches in sustainable investing are exclusionary screening and ESG integration. The first one is mainly driven by ethical motives, for example, when you exclude some sin stocks. And the second one can be driven by ethical motives, but it's also driven by the anticipation of future financial risks that are imperfectly priced by the market. For example, when you overweight green stocks and you underweight brown stocks. The main question of this work is how do these two sustainable investing practices separately and together affect asset returns from a theoretical point of view and an empirical point of view. The main contributions of this work are summarized in this table. I show that exclusionary screening induces two exclusion premia, and ESG integration induces a direct taste premium and an adjustment of the market premium. I also find cross effects of the taste and exclusion premia on excluded and non-excluded assets. I validate the model using US stocks between 2007 and 2019, applied to sin stocks for exclusion I find a 1.5% premium per year. And applied to green investing for ESG integration, I use green fund holdings to capture the aggregated revealed tastes of green investors, the growth in green investing, and the unexpected shifts in their tastes. I find on average 0.50% per year premium between green industries and brown industries. We will go through this issue a bit later. And I find also significant but small cross effects. To do so, I build a single period model with partial segmentation and heterogeneous preferences. There are three investor groups: regular investors who can invest in the whole market, excluders who can only invest in investable assets and exclude assets, and integrators for ESG integration who can invest in the whole market but internalize the private cost of externalities C. When C is high, you can think of brown stocks, for example, and when C is low, you can think of green stocks, for example. P and PI refer to the proportion of worth of excluders and integrators, respectively. CMI is the cost of externality of the investable market, and Q is the proportion of the excluded market in the total market. This is the main equilibrium equation of the paper that I call sustainable CAPM. I show that the expected return on any asset can be expressed this way as a function of the expected return on the investable market, adjusted by a term. There are two taste premia and two exclusion premia. We can rewrite this equation for investable assets and excluded assets. For investable assets, the equation simplifies. There is only one direct taste premium. As you can see, the adjustment of the market premium is the direct taste premium on the investable market. And there is a cross effect of exclusion and investable assets that I call exclusion market premium. The equation does not simplify for excluded assets. We have two taste premia and two exclusion premia. And you see there is an indirect effect of investable asset, of the taste for investable assets on excluded assets here. So let's now dig deeper into the two taste premia and the two exclusion premia to understand how they work. The taste premia arise via three channels. A direct taste premium, which is the main effect on investable assets and excluded assets. It increases with the cost of externality of assets. So when, for example, a stock is brown, then integrators will require a higher expected return to hold this stock. And it also increases with the proportion of investors who practice ESG integration. There is also this adjustment of the market premium by the direct taste premium on the investable market. And therefore, the taste effect is basically a relative effect. Is the difference between the direct taste premium on any asset minus beta times the direct taste premium on the investable market. If there is no exclusion, it's minus beta times the direct taste premium on the whole market. And there is also this indirect effect. I won't go through it today, please. There are these two exclusion premia. To understand these two exclusion premia, we can rewrite these two conditional covariances as a difference between two covariances. And the first effect is induced by investors who do not exclude. Since they are the only one holding the excluded market, they value most highly the assets that are the least correlated with the excluded market. And therefore, in this case, the first term is low. The second term is driven by investors who exclude the excluded market. Since they cannot hold the excluded market, they are willing to hold the replicating portfolio of the excluded market made up with investable assets. Therefore, they value most highly the assets of which the replicating portfolio is the most correlated with the replicating portfolio of the excluded market. Therefore, in this case, the second term is low. I also show that the exclusion asset premium is a generalized form of the premium on neglected stocks that has been evidenced by Merton in 1997. So in a generalized case, when assets are not independent, when asset returns are not independent, what Merton finds basically is a conditional covariance. And lastly, for the theoretical part, as you might know from Hong and Kakpersik or from Chava, there is a premium on excluded stocks, and they did an empirical analysis to show that. I show from a theoretical point of view that this is true on average for the excluded market portfolio, but this is not necessarily true for assets taken individually. So an asset taken individually can have a negative effect of exclusion. I estimate the model, apply exclusion. So I follow Hong and Kakpersik to identify the 52 scene stocks of the three scene industries, which are alcohol, tobacco, and gaming. What is more tricky is to apply the model to green investing for ESG integration, because I need to have a proxy for the cost of externality C and the proportion of integrators PI. I argue that the environmental metrics that are made available by data providers are weak proxies for the cost of externalities for several reasons, mainly because they lack a common definition and therefore they show low commensurability, but also because they are often available at a yearly frequency. So the idea behind this proxy is to compare green investors' asset allocation to the market allocation. I show that we can proxy, using first-order approximations, we can proxy the cost of externalities as a relative weight differential. The weight of any asset IK in the market minus the weight of this asset in the portfolio of ESG integrators divided by the weight of this asset in the market. And therefore, when integrators underweight an asset, the cost of externality will be, the proxy for the cost of externality will be high, so it's a brown asset. And when they strongly overweight this asset, therefore the CTIL will be negative, and it will correspond to a green stock. So the idea to do that is to look at green fund holdings. That's what I do. At the end of 2019, I consider the 453 green funds. I aggregate them, and I estimate industry on a quarterly basis to estimate this WI star and to input it in CTILT. WM, the weight of each industry in the market, is only estimated at the weight of this industry in the investment universe using CRISP. This proxy has several advantages. It's an agnostic instrument that captures the revealed average taste of green investors, and also it has a broad coverage. To proxy for the proportion of integrators, I define PLT as the market value of green funds divided by the total market cap. Let's move directly to the main results. This is the main table for investable assets. As you can see, the direct taste premium is significant and its loading is positive as expected. The cross effect of exclusion is not significant in this case. And I also find that the average market effect that affects the market premium is really low. Therefore, the taste effect, which I recall is a relative effect, is mainly driven by the direct taste premium. So we can estimate the annual taste effect for each industry. If we compare, for example, the petroleum and natural gas industry to the electrical equipment industry, we find a spread that is approximately 50 basis points per year between 2007 and 2019, which means that ESG integration induces an incremental cost of capital on brown companies of 50 basis points compared to green industries, to green companies or green industries. I performed several robustness checks. I'd like to emphasize the fourth one, which has been suggested by Pastor Stambo and Taylor. Indeed, when you proxy the expected returns in equilibrium by the realized return, you omit a critical variable, which is the unexpected shifts in taste. Indeed, when the taste for green asset increases between T-1 and T, the realized return will be higher for the green stocks compared to the brown stocks, and yet the direct taste premium will be lower for green stocks. So we definitely need to capture and control for the unexpected shifts in taste. The use of green fund holdings allow me to construct a proxy for this variable as the difference between the direct taste premium in T minus the direct taste premium in T-1. And I estimate the augmented specification with this proxy. I find all the variables significant and their loading having the expected sign. I also find that the cross effect of exclusion is significant in this case. The taste effect increases over time. And I leave you with this for the investable assets. Let's move directly to the excluded assets applied to sin stocks. The two exclusion premia are significant, and their loading is positive as expected. The cross effect of the taste for investable assets on excluded assets is also positive, and its loading is negative as expected. The average exclusion effect is approximately 1.5% per year in the US between 2007 and 2019, which is pretty much consistent with what Hong and Kakbersik find in a different period. In addition, I have the ability to estimate the proportion of investors who exclude sin stocks during this period, and it is approximately equal to 20%. As predicted by the theory, the average exclusion effect is positive, but 10 sin stocks out of 52 have a negative exclusion effect, and it is mainly due to the fact that they have a low correlation with the excluded market. I also performed several business checks. Let me focus only on this one. I showed that the dynamics of the exclusion effect is mainly driven by the correlation among excluded stocks. So when sin stocks are strongly correlated, the exclusion effect will be high. And this is the case during times of crisis where there is a high correlation among assets. That's why the exclusion effect increases during this time period. I will leave you with the main table I show you at the beginning of this presentation, and I thank you very much for your attention.
Thank you very much, Olivier David, for that presentation. And yeah, we'll come to some questions. We'll have the opportunity for questions at the end of this session. So with that, I'd like to keep things moving and turn over to our next presenter, who is Costanza Consolandi. And her paper will be on a paper entitled Better Fewer But Better, Stock Returns and the Financial Relevance and Financial Intensity of Materiality. Costanza Consolandi, PhD, is Associate Professor of Corporate Finance at the University of Siena, where she is a member of the steering committee of the MSc in Finance and a member of the University Board of Directors. She is also an external SDG expert for KKS Advisors since 2019, and she is also a consultant for the investment area of MAPFRE, the largest Spanish insurance group. So with that, I'd like to hand over to you for your presentation, Costanza. Thank you.
Thank you, Rodri. And let me share my presentation. And it's okay. So good afternoon, everybody. Here in Italy is afternoon. And this paper I wrote with two colleagues and friends, Paolo Gabbi and Bob Eccles, is about ESG materiality, is in the framework and the arena of the relationship between ESG materiality and financial performance. But with this paper, we aimed at going beyond the classical research question of the previous paper and research on ESG materiality and financial performance, which was essentially, does ESG materiality matter? And we tend to go beyond the binary approach adopted in this previous paper, where an ESG issue is material or it isn't. And so asking and respond to the research question is, does financial relevance and intensity of ESG materiality matter? Or in other words, does the quality of materiality matter? Indeed, we think and believe that the quality of materiality and the quantity of materiality, it is an issue that needs to be further investigated. So to do this, let me precise that we adopted in our framework the approach of materiality from SASB, from the Sustainability Accounting Standard Board. So materiality is an issue is material on an investor perspective. And a deeper analysis of SASB financial materiality, from a deeper analysis, we can see that, first of all, the number of material issues varies across industries, and not all material issues are equally financially material. So what does it mean that the number of material issues varies across industries? Well, if you look at the materiality, SASB materiality map, and we consider two industries like tobacco industry or healthcare delivery, here we have the two extremes value. So tobacco industries has only 2 material issues, and healthcare delivery has the maximum number of material issues within SASB framework, which is equal to 11 material issues. So the number of material issues varies across industries, and this is an issue that we think it is necessary to be taken into consideration. And the other point is, not all material issues are equally financially relevant. So very briefly, when SASB identifies an issue as material, it means that the issue impacts at least one value driver. SASB in its framework considers 13 value drivers. So for each material issue, SASB defines which are the value drivers impacted at the industry level. And moreover, when a value driver is impacted by a material issue, the strength and intensity of its impact would be higher or medium, higher, medium. So these the impact is labeled by SASB as high or medium. So considering these 2 points, we can go beyond the binary approach and assess the financial relevance of each industry. What does it imply? If we consider the materiality map I showed before of the 2 industries, what happens? Here is the situation of the 2 industries if we consider also the financial relevance of the material issues. So as we can notice on the right, on the figure on the right side of the screen, so tobacco has only 2 material issues, but they are strongly and highly financial relevant. Whereas healthcare delivery has many material issues, but the materiality and the financial relevance is more, let's say, diluted. So does it have an impact? So in order to do this, we developed a novel data set, and we measured the quantity and quality of ESG materiality. So we created 3 indexes. One is the materiality intensity index, which is the gives you the information about the quality, the quantity of materiality is the number of material issues over the total non-financial issues. Then the financial relevant index, which gives you the information about the value drivers impacted by the material issues at the industry level, and moreover the financial intensity index, which gives you the information about the strength of the impact, the financial impact on material issues. And finally, the combined effect of these quantity and quality of materiality has been assessed through a Gini index of ESG materiality. In order to check if this quantity and quality materiality is relevant for financial performance, we conducted an empirical analysis on a sample of US listed companies, US companies in the Russell 3000 from 2008 to July 2019, using sustainability data from True Value Labs. We use True Value Labs inside SCORE. True Value Labs provides information on sentiment on ESG performance on a daily and monthly basis. On a daily basis, we work on a monthly basis. The sample selection criteria we included in our sample only those companies for which at the end of each month the score on each material issues were available. And we obtained a final sample of 731 companies and roughly 60,000 observations. So the first empirical analysis, so obtaining in this way an unbalanced panel, and where the majority of companies were in the food and beverage sector, high proportion of the service sector and infrastructure. But in general, let's say the sector composition is, well, let's say quite homogeneous. Well, not much, but so the first approach, so the first part of our empirical analysis, we ran a panel regression with using a modified Fama-French three factors model. So where we added to the classical three factors model also the quantity and quality of materiality, and of course the ESG momentum, the ESG performance. In we used the Fama-French CAPM and then the Fama-French three factors model to see if in our sample the classical asset pricing model were significant, and as we can see from this slide, they were. Then we added to the three factors a fourth factor given by the ESG material score momentum in order to see if we could confirm also with our analysis the positive results about the relationship between material ESG performance and financial performance, and we could. And finally, we added the model 4, 5, and 6, also the quantity and quality of materiality, the three indexes. But what is interesting is to see what happens with model 7, so where we added the Gini index of materiality. Our results show that, of course, the traditional asset pricing model are confirmed, and the expected positive sign of the ESG score momentum is confirmed. What is interesting for us is that the positive and significant and the significance of the Gini index. So as we know, the highest is the value of the Gini index, the highest is the concentration of the materiality. What we could notice for the results is that the equity premium of US stocks in our sample is explained more by the concentration of material issues than by the momentum of the ESG scores, both in terms of sensitivity and the statistical significance of the results. So we could say from this that better fewer, but better. Then a further test we performed was aimed at assessing if using these explanatory factor as weights in a portfolio could confirm the results we obtained before. So using the same stocks of the analysis, we built 3 portfolios. So we used the first portfolio as a traditional market capitalization weighted portfolio, and then we adjusted the market capitalization weighted using the ESG momentum portfolio, and finally we added as a further weight the Gini index, of materiality. Of course, from the results we obtained in the previous analysis, we expect that the performance of the ESG plus Gini weighted portfolio would be higher than the market plus the ESG momentum weighted and of the market weighted portfolio, so as a benchmark portfolio. And indeed, this is what we obtained. So here we can see which are the cumulative results from on the figure on the left side of our screen shows the cumulative results. So the blue line is the cumulative results of the market value plus the ESG momentum and Gini weighted portfolio. As we can see, it outperforms the other two. What is interesting is that the outperformance increased starting from 2015. And as you know, 2015 is the year in which we started, in which ESG materiality has started to become a very important topic in the arena of sustainable finance. And this fact is further confirmed by the cumulative active returns. So the green line is the cumulative active returns of the ESG momentum plus market weighted plus ESG momentum and Gini. As we can see, the overperformance of these the highest active returns started to increase in 2015. So this is something that confirms which are the driver for the increased importance of ESG materiality among institutional investors. Other results, I do not want to bother you with the tables you can find in the paper, but just to summarize the other more accurate results is that if we consider, for example, a 5 years holding period, always we have a dominance of the ESG momentum plus Gini weighted portfolio. But what is interesting that also we have a higher tracking error volatility, and this is a premise of the fact that in our analysis, whilst we see that the ESG momentum plus Gini weighting tends to an overperformance of the portfolio, also the riskiness of the portfolio is higher. Of course, as the overperformance is higher than the increased risk, so the risk-adjusted results, the risk-adjusted performance is always higher. But what is interesting also for us is that the higher risk of the Gini-weighted portfolio that can be explained by the concentration of the material issues. Which are the implications we think of our analysis? So I think that we think that our analysis might have implications both for companies and for investors. For companies belonging to industries in which SASB identifies a high number of material issues, our results might raise the question if whether these companies should choose a subset of material issues to focus and to communicate to investors. Is it relevant or not? So companies should focus on a lower number of material issues, so the most financially relevant. And for investors, that our results also show that when they consider ESG momentum, they also need to consider the concentration of material issues as one of the criteria for portfolio management. Our results show that the market does not believe that having 2 material targets is credible. So again, better fewer but better. But further steps, of course, portfolio strategy based on ESG materiality concentration, or let's say diversification, will be is an important topic that will be investigated in another paper we are currently working on. So stay tuned. Thank you very much, and thanks for the opportunity to share these results.
Sandra, for that presentation, and that just leaves us with time for our final presentation in this session, which is by James McGlinch, and his paper is titled Enhancing Profits and Reducing Losses by Managing Material, Environmental, Social and Governance Factors. James McGlinch is a doctoral student at the Wharton School at the University of Pennsylvania. His research focuses on the integration of ESG issues into corporate strategy and the ways through which such integration impacts firm performance. Prior to being at the Wharton School, James held roles in the industry. He held roles in investment banking at Credit Suisse and in investment research at Goldman Sachs and Barclays Capital, and James is a CFA charter holder. James, over to you. Thank you.
All right. Roger, thank you for that kind introduction now that I have myself sorted out here. And thank you to everyone else for joining today. I'll be presenting an ongoing project co-authored with Professor Veet Hennish, also of the Wharton School, where we seek to examine the when and how of an economically substantive relationship between ESG performance and firm value outcomes. To set the table here, although there is no shortage of studies that consider the relationship between corporate social performance and corporate financial performance, these studies and the review of past findings often highlight specific challenges in evaluating the economic significance of this relationship. These challenges include measuring corporate social performance, the heterogeneity of measures used to measure financial performance, and challenges related to concretely identifying the mechanisms that link the two. To address these challenges, we first build on recent developments in the academic literature by focusing on a discrete subset of ESG issues, of which a few are identified as material to firms by the Sustainability Accounting Standards Board. Second, we increase the precision with which these material ESG factors influence financial performance by linking them not to end state corporate level outcomes, but rather a series of intermediate accounting related metrics. Lastly, we integrate value-based theory with stakeholder theory to identify more precise predictions regarding how and where a firm with distinct stakeholder groups that are characterized by a given distribution of bargaining power can create value for those specific stakeholders in a way that is additive to financial performance. Characterizing the firm as a collection of stakeholders that both create and appropriate value allows us to synthesize prior arguments linking social and financial performance into an alternative narrative that encompasses the risks of value erosion and the benefits of value protection. Specifically, it appears that total value across all stakeholders can be enhanced by either increasing customer willingness to pay, decreasing the costs of goods and services supplied, reducing the incidence of legal and regulatory interventions, or increasing employee productivity outcomes. From this, we derive our 4 hypotheses, as can be seen on the screen, including that material ESG performance is positively associated with top-line growth outcomes, positively associated with incidence of cost reductions, negatively associated with legal and regulatory interventions, and positively associated with favorable employee productivity outcomes. However, looking to take this a step further, we next consider not just ESG performance along these material dimensions, but the importance of the implicated stakeholder in each of these pathways to a specific firm. Specifically, as the bargaining power of the implicated stakeholder in each of these four pathways increases, we would expect to see strengthening correlations between ESG performance and these outlined firm value events. Going in order from top to bottom, beginning with 1B, we would expect the association between material ESG performance and top-line growth outcomes to be increasing in the bargaining power of customers. For 2B, we would expect the association between material ESG performance and the occurrence of cost reductions to strengthen with the bargaining power of suppliers. For 3B, we would expect the negative association between material ESG performance and legal or regulatory interventions, such as being named the defendant in a legal lawsuit or the target of a regulatory inquiry, to strengthen with the bargaining power of regulators. Lastly, we posit that the positive association that we hypothesize between material ESG performance and positive employee productivity outcomes would strengthen with the bargaining power of employees. To test our hypotheses, we apply them to a sample of over 2,300 actively traded public companies that were members of the S&P 1500 between 2007 and 2018. This includes those firms that also entered or exited the list during this time. We employ probit regression models with random effects and robust standard errors, given our hypotheses are primarily concerned with how material ESG performance is associated with the occurrence of specific outcome events that either contribute to or detract from firm value. To develop our dependent variables, we begin by looking at intermediate firm value metrics, which connect corporate ESG performance with end-state firm value outcomes that were been previously studied in the literature. However, because many of these outcomes are related to market expectations or guidance and aren't necessarily captured in traditional financial results, it is necessary we find a data source that can measure these outcomes from other sources of company information, including press releases and earnings calls. For this, we turn to Ravenpack News Analytics, a news source aggregator. Through access to news sources like the Wall Street Journal, in addition to company press releases, Ravenpack is able to codify news on 40,000 plus companies and institutions, covering 98% of all global investable assets. Using the Ravenpack categorizations for identified events related to firm value outcomes, like revenue guidance increases for top-line growth or expense guidance reductions for cost reductions, we create a binary variable code as 1 if events representative of a firm value event occurred within a given quarter, and 0 otherwise. Turning now to our independent variable, material ESG performance. Similar to the last presentation, we turn to ESG data from True Value Labs. True Value not only measures a firm's ESG performance across 26 distinct categories and includes overall scores across material categories, it is the first big data provider of ESG data and collects data on over 17,000 companies from 100,000 vetted sources as of 2019. To derive performance across all these categories, True Value employs a natural language parsing algorithm to read each information source and categorize it by ESG issue as positive or negative. From this, they then create an ESG insight score ranging from 0 to 100, with higher scores indicating better ESG performance. Using the material insight ESG score from True Value, we then convert these scores into percentile rankings by a firm's industry to arrive at our main independent variable, material ESG performance. We also identify 4 variables to proxy for the relative bargaining power of these stakeholder groups, which we then use to split our samples to test the 4 B-related hypotheses. These include advertising intensity to proxy for the bargaining power of customers, industry competition for suppliers, industry regulation for public sector actors, and the employees to sales ratio for employees. Turning next to our results, instead of showing you over 20 of these different bin scatter plots, given the time limitations, I'll show a representative sample of results from the paper to make sure I stay under my 10-minute limit. Starting with hypothesis 1A, which suggests that firms with better material ESG performance will be more likely to experience unexpected increases in top-line growth, we use three dependent variables to evaluate this. These include increases in revenue guidance, increases in the price of products or services offered by the firm, and hiring activity. On the screen is a bin scatter plot summarizing the relationship between material ESG performance, which again is measured as an industry percentile, and probability of increases to revenue guidance, controlling for the variables that were mentioned in the methodology slide. These include size, leverage, profitability, and credit rating, among others. The line in the chart with the 8% next to it compares a firm in the bottom quintile for material ESG performance to one in the top quintile, all else equal. Next, we turn to hypothesis 1B, which suggests that the correlations witnessed between material ESG performance and top-line growth will be increasing in the bargaining power of customers. To evaluate this, we split the sample based on our proxy for customer bargaining power, advertising intensity. The first subsample above in red contains those firms where customers would be expected to possess higher bargaining power, while those in green would be expected to possess lower bargaining power. Here, comparing a firm from the first to one in the fifth quintile of material ESG performance, again, all else equal, the latter would be predicted to have rates of revenue guidance increases 9% higher than the former when customer bargaining power is high, compared to only 5% when customer bargaining power is low. Turning now to a negative firm value event, hypothesis 3A predicts a negative association between material ESG performance and interventions from legal actions or regulatory bodies. Here, we are looking at legal interventions measured as a firm being named a defendant in a lawsuit during the quarter. As can be seen on the bin scatter plot on the screen, a firm in the top quintile in material ESG performance compared to one in the bottom quintile, holding all else equal, would we expect to have a rate of legal interventions 35% lower than the former. Next, we look at how this relationship changes based on the bargaining power of governments and their constituents. To proxy for this bargaining power, we divide our sample based on above or below median industry regulation, using industry regulation data from reg data to reflect the bargaining power of government stakeholders. As hypothesized earlier, the relationship between ESG performance and legal and regulatory interventions appears stronger for firms in more regulated industries. Comparing a firm from the first to one in the fifth quintile of material ESG performance, again, it appears the latter would be predicted to have a rate of legal interventions 46% lower than the former when bargaining power is high, compared to just 21% when this is low. Quickly, before concluding, I did want to share the correlations we do see between our material ESG performance measures and corporate level financial outcomes that are often otherwise studied in the literature, including Tobin's Q and ROA, when we include some of the controls we included in our prior regressions. Additionally, positive Ravenpack events that we use as our dependent variables here do appear to be associated with declines in CDS spreads in the subsequent quarter, while negative events appear to be correlated with increases in CDS spreads. With that, to conclude, we feel our theoretical arguments and empirical results point to the existence of an economically substantive relationship between a firm's management of material ESG factors, as perceived by third-party media reports, and the incidence of multiple material financial events that impact those firms' P&L. While these results are admittedly correlational, we have taken great care to show contingencies and moderating effects consistent with a causal relationship linking the relative bargaining power of a given stakeholder to a specific mechanism of value protection, capture, and appropriation. With that, I would like to thank all of you for your time and turn it back over to our moderator, Rodri, for what I believe is going to be some Q&A.
Okay, thank you very much for that presentation, James. So yeah, we have a few minutes left here for Q&A. I've been monitoring the questions as they've been coming in here on the platform. And starting with the one that's received the most votes is actually for Olivier David. And the question here is, can you speak in more plain terms about the exclusion and taste premia that you referred to in your study? And I think in the paper, you note that the annual taste effect ranges from around minus 1.1% to plus 0.14% for the different industries, and the average exclusion effect is plus 1.43%. So can you talk a little bit more about those ranges and give a more generic discussion about the magnitude of that and what that actually means for your findings?
Yes, sure. So, as you said, the exclusion premium exclusion effect is 1.5% on average, but it's an average effect. So you can have seen stocks that will have, or excluded stocks that will have a negative effect. But indeed, if you want to keep in mind an order of magnitude, it's 1.5%, and it's quite consistent with what Hong and Kaspersky found. It's more, they found like 2.2 or 2.5%, depending on what they test, on a longer period. So this is the order of magnitude, and the main message is that it can be negative. For the taste premium, you need to consider to compare two industries if you want to have an order of magnitude in mind. And if you compare a very brown industry to a very green industry in the US during this time period, it's on average 0.5%. Today, it's more about 1% between a green industry and a brown industry. And this is in the US. I think I didn't test that, but I think in Europe it will be higher. And one last point is that you cannot rigorously estimate the expected returns using the realized return because you omit a critical variable. Yes, I think the fact that when we talk about performance, some people talk about expected returns, and some people talk about realized returns. And there is we need to be careful when we test an equilibrium equation about expected returns, because it is in equilibrium, and realized returns. I don't know if I answered correctly your question.
Thank you, Olivier David. I'm going to turn now to a question that's being directed towards Costanza. And the question here is, it would be great if you could speak to how you disentangle the circularity of whether materiality matters. So I think one of the interesting innovations in your paper is that you note that this issue of materiality is not binary, and you consider the question of how material is a material issue. So I wonder if you can talk a little bit more about that, and to what extent does this concept of how material is a material issue perhaps vary between financial issues and some of the non-financial issues as well?
Yeah, sure. Yes, what we did, we use these indexes to assess the quantity and the quality of materiality. So for each material issue, what is the binary approach is material, yes. What we tried to do, what we did was to measure how material was a material issue, and the measure of how material is a material issue depends on how many value drivers it impacts, let's say it affects, and the strength of its impact. So we did this index for each material issues for each industry. So assuming that if two industries have the same material issue as material, let's say supply chain management, but for one industry, supply chain management might be more material, so more financially relevant than for another industry. So we considered each material issue at the industry level, and then averaging the financial relevance index or the financial intensity index, as we called these measures, we defined an industry level of financial relevance and intensity. I don't know if I replied to your question. So what we did in our empirical analysis, we control for the quality and quantity of materiality that the combined effect has been measured through the Gini index, so the concentration of materiality. So essentially, we measured how much the materiality of an industry level is more or less concentrated. I don't know if I answered your question.
Thank you, Costanza. It's a fascinating discussion, and I'm sure we would love to have more time to continue this, but unfortunately we are out of time. So let me conclude by saying thank you very much to the speakers for your excellent presentations today. And may I encourage the delegates to return to the networking area of this conference, where you can continue to interact with your colleagues and ask questions if you haven't had time to ask them today to some of the speakers. So thank you very much for your attendance, and best wishes with the rest of the conference. Thank you.